Did you know that if you're a Canadian small business owner, that you can actually pay yourself tax-free dividends out of your corporation? Well, you can. And today we're going to go over exactly how you can do that, some of the requirements for actually paying some of these tax-free dividends to yourself, and go over a specific example so you can see exactly how this could benefit you in retirement and save you thousands upon thousands of dollars. So you may be thinking, okay, this sounds too good to be true, right? Well, it's actually not. What these tax-free dividends are actually called is capital dividends. And you don't have to take my word for it. You can go right on the CRA website and confirm that, yes, capital dividends are, you are allowed to pay yourself these tax-free dividends. There's two questions you might be asking yourself. One, do I have a capital dividend account balance? Right? Because your corporation actually builds up capital dividends inside your corporation, and you have to make a special election to actually pay them out to you. And the next question, if you don't have any of these capital dividends, how do I generate them? So the first part, if you want to check to see if you have a capital dividend account balance for your corporation, it's very simple. You just look up your corporate tax return, you look up Schedule 89, Part 6. That will essentially tell you what your capital dividend account balance is across all the different components in there, and that's it. It's worthwhile checking. Even with when you're dealing with an accountant, it's possible that you could have a balance in there that your accountant just hasn't had the conversation with you on paying these out. So it's worth a conversation with your accountant if you do have a balance in there. One particular example that I've seen is if you have a capital dividend account balance and let's call it $40,000 and it hasn't been paid out, that's an opportunity for you to pay yourself a $40,000 tax-free dividend from your corporation to yourself personally. And if you haven't maxed out your tax-free savings account room, this is a perfect opportunity to move assets from your corporation into your personal name and into a registered account, continuing to compound tax-free. Now, I would like to note very quickly that there actually are a couple requirements in order to make sure that these tax-free dividends are tax-free. One, you have to be the owner and a director of a Canadian private corporation. It cannot be a public corporation. The capital dividends have to be paid out to the director. And two, you have to be a resident of Canada. You can pay these capital dividends if you're a non-resident of Canada. Withholding tax rates do apply in that scenario, so I won't call it completely tax-free. So now you're wondering, how do I generate these capital dividends inside my personal corporation? Well, there's three ways. One is through the non-taxable portion of capital gains. Two is through life insurance proceeds, and three is from capital dividends from another corporation. So generally, life insurance proceeds and the non-taxable portion of capital gains, that's what's really going to generate your capital dividend account balance in this scenario. And in this particular video, we're only going to focus on the non-taxable portion of capital gains. So in order to generate capital dividend through the non-taxable portion of capital gains, it's very simple. Let's consider you had Fund A and you bought it last year for $100,000. And now this year, for simplicity's sake, this fund has gone up to $200,000 and you decide to sell out. Well, what you have is a $100,000 capital gain. And how that's taxed inside your corporation is that 50% of the balance is taxed at the corporation's marginal tax rate for passive investments, which in Ontario it's 53.53%, basically making an effective tax rate of 26%. But the other portion of the capital gain of that $100,000, half of it gets added to your capital dividend account balance. So you now have $50,000 that gets added to your CDA balance inside your corporation. Now, at the end of that year, you are now able to pay yourself a $50,000 tax-free dividend from your corporation to yourself personally. And that's as simple as it is. The non-taxable portion of capital gains gets added to your CDA balance, and from that CDA balance, you can now pay yourself a tax-free dividend. All right, so putting it all together, let's go through one specific example so you can see exactly how it could benefit you by generating these capital dividends to be paid out to yourself personally. So in this example, let's discuss George, small business owner. Inside his corporation, he has $2 million of investable assets, and outside of his corporation, he's getting CPP, old age security, and he has some RIF income. Let's assume his RIF income plus his CPP and old age security is about $80,000 a year, and he wants to spend, $125,000, $130,000 after tax. Let's assume that his corporate investment assets, his $2 million portfolio, generates a 6% capital gain distribution on an annual basis. What that looks like is $120,000 of capital gains generated annually. Now, if we split that up, what that really is comprised of is $60,000 that gets taxed at the corporation's marginal tax rate for passive investments, and the other $60,000 gets added to the capital dividend account balance. So in theory, every year, George could pay himself a tax-free dividend, a capital dividend of $60,000 out of his corporation to himself personally, and add on to that extra $80,000 of taxable income he already receives and bump it up to $140,000, okay? Now, the benefit here is not only is it a completely tax-free dividend, where if he were to pay himself an eligible or ineligible dividend, there would be tax owing on that. And in that scenario, if he paid out that much of a dividend, his old age security would be completely clawed back, because by the time he has $135,000, $140,000 of taxable income, his old age security is completely clawed back. He doesn't receive any benefit there. However, if he took the $60,000 capital dividend and paid that to himself annually, not only could he meet his income objectives or his after-tax income objectives for retirement, but he could also maintain the entirety of his old age security payment. And this could be up to $10,000 a year, depending on how much he delayed his old age security. So just there, you can see, not only does it benefit you by doing this, by paying yourself capital dividends, not only can you fully maintain your old age security payout, but of course, there's additional benefits of even just paying less tax. If you received any value out of today's video, please give the video a like. And if you have any specific questions about your situation, feel free to reach out to me. I'll post a link to my calendar down in the description below. You can always get in touch with me and we can discuss further. Until next time, thanks for watching.